So those are capital gains tax rates, 20%. Wouldn't it be nice to get those tax rates across the board? This chart is giving this administration license to cut spending and streamline the government in as many ways as possible, especially regulations, to stir economic activity. So the way to get the deficit down, so to get this line moving up, there are a couple of ways, actually. Cutting spending, which of course this administration is doing, raising taxes, which they do not want to do, except, interestingly, for perhaps private equity. We'll see if this time around the private equity tax breaks are eliminated. You know, philosophically, I don't really want tax rates to go up for almost anyone. I'm thinking, wouldn't it be nice to get the tax rates that private equity enjoys? So those are capital gains tax rates, 20%. Wouldn't it be nice to get those tax rates across the board in investing, including for companies like ours? We, of course, are subject to the maximum tax rate in terms of our own income. What about getting that closer to 20%? That would be consistent with a flat tax. So really paying a lot of attention to the direction taxes are going to go. And I think it's going to be very positive for the financial markets. The other way to get this deficit down is to grow the economy very rapidly, more rapidly than it has grown over time. And we think that is possible. I will get back to that when we get to our big ideas. We have a strong point of view about how much faster the economy could grow as this administration unleashes incentives for innovation and increased productivity, accelerated GDP growth. So we think the various programs are going to take this deficit certainly to where Treasury Secretary Bessent wants to get it, and that's 3%, minus 3% relative to GDP. But if this administration is successful in getting growth moving quickly as well, which we think it will be, we could get closer to that 0% mark. Now, here is the chart I was talking about, tariffs versus income tax rates, both individual and corporate. At one point in our history, our early history, tariffs were the majority of government income. And you can see the switch in the early 1900s to income tax rates. I think the first income tax rate was 1%. And of course, now the maximum tax rate is, I think, more than 37% for individuals. I think that President Trump would like to get the share shift going again towards lower income tax rates and maybe higher tariffs. And maybe that's not a bad thing. I'm not a fan of any increased taxes, but it certainly did work well in the early days of our history. Here you can see, and this is updated for the latest real GDP growth and productivity numbers, we're around that 2.5% number for both right now. We'll get into this in a moment, but in the short term, given all of the uncertainties, we could see these dipping a bit until this administration has its programs in place. And the other reason it could dip a bit is because the velocity of money, I'll get into that in a moment, is already starting to slow. And so we'll touch on that in a moment. The dollar going up, combined with productivity gains, those are two powerful anti-inflationary forces, and we do believe they're going to work. So the market's fears about inflation reigniting, we think, are misplaced. The yield curve, this has been an interesting story over the last really more than 13 years. You can see that the yield curve, which is the difference between long-term and short-term interest rates, short-term usually are lower than long-term interest rates. But you can see the slope. We've been in a declining slope in terms of this yield curve for the past 13, 14 years. And we ended up in an inverted yield curve for a little more than a year's time. Inverted meant long rates were lower than short rates. That has flipped back around recently, and so we're going to be testing this downtrend. We could see a little more steepening, and we'll see if this downtrend has been broken. Why are we paying attention to this downtrend? I believe that the fixed income market has been sniffing out some deflationary undercurrents, and so long rates have not moved much above short-term rates because they are very much influenced by inflation.